QuickBooks Pro Desktop 2021 forward contract transaction within QuickBooks. Let's get into it within It's QuickBooks Pro Desktop 2021. Here we are in our problem 4 practice problem. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we had a purchase that we made on account for property, plant, and equipment that we're going to be paying in the future in foreign currency. And now we're thinking about how to set up and mitigate the risk with a forward contract, which we talked about a bit in the terms of Excel. Now we want to put it in to QuickBooks. So let's see where we are at this point by going to the reports dropdown. Company and financial, take a look at that balance sheet standard, the standard balance sheet. We're going to go to the customize reports up top and then change the dates from 01/01/21 to 12/31/21 and then say OK. So this is what we have thus far. So we have our machinery on the books. We have our payable on the books. That payable, because it's going to be paid in foreign currency, in our case Australian dollars, is going to have a bit of risk to it. We're going to think about how we can mitigate that risk with a forward contract. So we're going to say, all right, this over in QuickBooks over here, or over in Excel, we started to put the forward contract in place. This is going to be the journal entry for it. We have a receivable on the books, a payable on the books that are going to be due at the same point in time that we're going to be paying off the payable for our depreciable asset that we purchased. And we want to set this up so that we have the receivable is going to be in the foreign currency. So that will kind of mitigate against the payable we have up top, which is going to be in the foreign currency. And then the other side of this transaction will be a receivable that will be in US dollars. So that then will not change. There will not be any kind of risk or change to this side of the transaction over here on the forward contract, because it'll be in US dollars. This one will then fluctuate. It should fluctuate in the opposite direction for the most part, you would think, than the payable up top, although it's a little bit different because we have to use the forward contract rates. So we put this payable on the books by taking the 100,000 that we expect to get in the future for the forward contract and pay, and then we're multiplied that times not the spot rate, which is kind of the twink in the system here. We had to multiply it times the forward rate, which is the projected rate into the future that we think that the valuation will be at the point in time that the end of the contract will be when the payment actually takes place. So this rate will fluctuate based a little bit differently than the spot rate, but that's what we have to work with. So we're going to put it on the books at the forward rate, and then we might have to revalue on the forward rate, and then at the end of the contract we'll be back to the spot rate, which will be the same under the two conditions, given the fact that we are at that point in time at the end of the process. Okay, so that's what we're going to do. We're going to put this on the books. What do we have to do so? We need a receivable in QuickBooks so that we can track it in a receivable, and we need that to be set up in a foreign currency so we can track the changes in the currency. We need a payable so that we can track the payable side of things. We're going to need a customer so we can put this on the books and tie it to a customer. We're going to need a vendor so we can put this on the books, tie it to the vendor. And I'm going to put it on the books with 2 transactions rather than just a journal entry so we can use the functionality within the QuickBooks system. So let's take a look at that. QuickBooks here, home page. Now, you would think we could just enter a journal entry by going to the company dropdown and then say make journal entry and just enter it just like we did in Excel, nice and easy. But sometimes QuickBooks doesn't let us have a payable and receivable in the same journal entry, and we would kind of like to use the functionality within QuickBooks, and the forms are the easiest thing to do that, to utilize the exchange options within it. Therefore, we're going to put it on the books as a bill and then an invoice to utilize those 2 options, and then we'll see how that will work out to the same journal entry that we will then have. So let's go to the lists drop down. Let's take a look at our chart of accounts, and we're going to need a receivable and a payable here. So the receivable is going to have to be in foreign currency. Let's do that one first. That's the more confusing one, by going to the account drop down or rise up, and we're going to go down to the new or up to the new. And then this is going to be an accounts receivable. Then we're going to continue on that one. And we want to make this receivable in foreign currency. So not US dollars and the Australian dollars. I'm just going to call it, receivable exchange broker. And then I'm going to say this is AUD. Well, let's just call it, I'm running out of space here. exchange broker, and I'll say AUD. So I'm going to make it specific to this transaction, this forward contract. And then we have it set up as the Australian dollar. So I'm going to say, all right, that looks good. So save it, close it. Then I want a payable to be set up, and I could use just the normal payable here, or even the accounts payable for the AUD with, we would use the normal payable in this case, because the normal payable is we're going to be paid in US dollars. But again, I kind of like to have another account that's going to be a payable type of account, so that it'll be the opposite of this one, and we can see it broken out separately rather than clumped together with other receivables and payable accounts. Therefore, I'm going to go down to the accounts, rise up, and have a new account. We're going to make this an accounts payable type of account, so I'm going to call it accounts payable, and then continue. So it's an accounts payable type, but I'm going to name it a little bit differently. I'm going to say it's a payable exchange broker. Let's say exchange broker, labeling it as the forward contract. Now this one here is going to be in US dollars, so we're going to keep it in the US dollars. This is the side of the contract, of the forward contract, that will remain constant in the US dollar. Therefore, if we wanted to, we may have been able to set up as an other current liability account, but I'm just going to keep it in a payable type of account. So I'm going to say save and close. So there we have that. Then if we take a look at our lists, I'm going to close this back out. Hit the lists drop down. Let's take a look at our currency lists now. We had opened up the Australian dollar before. That's what we're going to be using. Now, if I double click on the Australian dollar and look at the rates, we have this rate on 12/1 at the 0.6. Now, if I was to just download that rate, and if it was in real time, that would be the current spot rate. And I can't use that rate for the forward contract because I need the forward rate. So, what I'd like to do, so what I need to be able to do is when I set up this transaction, I need to be able to use the forward rate and be able to know that I need to use something different than the 0.6. I'm going to go ahead and set that up when we make the exchange, when we make the transaction, rather than putting a new rate here, which would be the forward rate, and keeping this at the spot rate. So we're going to then close that back out. We need to then set up a customer and a vendor. So I'm going to close this out too. So I'm going to go to the customer dropdown and set up a new customer. So let's set up another customer, and I'm going to say this is going to be a dropdown new customer. And this is the one we need in the foreign currency. So I'm going to say this is the exchange broker, and I'm going to say this is AUD, and this is going to be a customer. And so, I want to label that kind of in the name so it's easy for me to see, because I'm going to have a vendor that's also named the exchange broker, and it's going to be in US dollars, and it's going to be a vendor. So then I want to put over here that this needs to be in Australian dollars. This is going to be Australian dollars. That looks good. Let's save it and okay. And then I'm going to close this out. We also need a vendor now. So let's go to the vendor center by going to the vendor drop down, and there's the vendor center. The vendor center. And then I'm going to hit the vendor drop down, and we want a new vendor. And this is going to be, once again, the exchange broker. Exchange broker. I always want to put an A in there, but I don't think it belongs. Exchange broker, and then this is in US dollars. And then this is going to be the vendor. And then this is going to be in US dollars, so we'll keep that there. That looks good. I'm going to say save it. And I think we have all the resources we need now we want to enter the bill. We want to enter the invoice. I'm going to put the other side of both the bill and the invoice to a clearing account, so it'll net itself out, and we can still use these tools to do the normal processing of recording these transactions. Let's do the invoice first, because it's going to be the more complex one due to the fact that it's in the foreign currency. So I'm going to say invoice. Let's open up the invoice. The invoice means it's going to increase the accounts receivable. We want it to increase the accounts receivable for the foreign currency. Therefore, I want to hit the drop down. We want the AUD foreign currency. And then over here, we want the exchange broker and for the customer. So the customer has to line up to the receivable currency type. And then we're going to set this up as of 12/01/21. And then it's saying, hey, you changed the date. Do you want us to change? I'm paraphrasing here. Do you want us to change the exchange rate? And we'll say, yeah, even though it's still wrong because it picked up the exchange rate, which is the spot rate, and we need it to be the forward rate. So we gotta kind of force the exchange rate here by putting that in at the 0.609. It needs to be 0.609, not just 0.6. 0.609, that's the forward rate. rather than the spot rate. And then I'm going to set up a new item here. The new item is going to be a service type item. And then I'm just going to call it forward contract. And the account that I want it to go to is not going to be an income or expense account. It would normally be an income account if this was a normal invoice, but it's not a normal invoice. It's special. And so we want to have a new account up top. And I don't want to make it an income or expense account because those clear out. I like to make it something on the balance sheet. So if there's a problem, it'll appear on the balance sheet, not wash out or roll over or close out to an equity account such as retained earnings or capital. So I want to put it into the other current asset type of account. I'm just going to call it clearing account. So that means that it's going to clear out. It should always be 0 at the end of the day. And I mean right after. This isn't like it's going to turn into 0 sometime in the future, but it should be 0 like right after we're done using it after this session. So I'm going to then say okay, and then there it is, the forward contract, and this is going to go on the books for the 100,000 Australian dollars, and there we have that. And then it uses the exchange and converts it to the 60,900 US dollars. So what's this going to do? Increase the accounts receivable for the amount that we're going to get, 100,000 Australian units, dollars, that we need to revalue in our currency with the current rate that we're going to use, which isn't the spot rate, but the forward rate. And that gives us the 60,900, which will actually be on our financial statements. The other side then going to not income, not revenue, but rather that clearing account, which will then wash out back to 0 when we enter the bill. So let's close it up and then check it out. So close it up and then we'll check it out. So here's closing process. Now we're doing the checking it out process. So we'll go back to the balance sheet and I'll say, don't show me that again, but do that. Yes. And then we have on the books now this receivable. There's the receivable we put on the books. And then we have this clearing account underneath that needs to go back down to 0. And then we have the payable on the books down below. Now let's do the other side. The other side is going to be the bill. So now we're going to enter the bill. So bill, and the bill means that accounts payable is going to go up. So it's going to be in the normal payable, this account though. We want the payable exchange broker one. That's the one. That's the one. And then we want this one to be the exchange broker in US dollars. So it's just in US dollars. So nothing funny's happening here, but we need to use the US dollars of the 60,900. So 6,900. And then the other side is going to go to, once again, the clearing account. So then this will wash down that clearing account back down to 0, clearing it, which that's like kind of what the name indicates. So it went up and then it goes back down. So the bill is going to go up in the accounts payable. The accounts payable is going to go up because it's a bill. And then the other side is going to bring that clearing account back on down to 0. This one is in US dollars. We're just going to put it on the equivalent value of the US dollars that will be we will pay in US dollars at the end of the forward exchange contract. So then we're going to say save it, close it, then we'll check it out. Saved, closed, checking out. Back to the balance sheet. We now have the receivable on the books at that 60,900. We've got the payable on the books at the 60,900, and then we had the original amount that was on the books for the contract that we're kind of we're mitigating the risk on, which is the 60,900, which is what we purchased. The machinery is 60,000, and then this accounts payable here that was related to it. So this accounts payable now, which resulted in some risk for us due to the change in the currency, we are mitigating because this will change because we're going to actually be paying in foreign currency. We're mitigating it by putting this receivable on the books, which is something we're going to receive in foreign currency that should kind of change in the opposite direction to mitigate the risk of that payable that we have. So then we could see this in a trial balance format, which might be easier to see. So we go to the reports dropdown, accounting and taxes. There's the trusty TB trial balance, changing the dates up top from 01/01/21 to 12/31/21. And so there we have it. Notice this clearing account is 0 because it cleared. If I double click on it, it went up, it went down, it's back at 0. Closing that back out, this is where we stand at this point in terms of the trial balance.